Hello, and welcome to today's webinar, 2016 Construction Materials Outlook, Recovery, the FAST Act, and the Great Reshuffling. This is brought to you by our sponsors, FMI, Telsmith, and Superior Industries. I'm Allison Barwatz from North Coast Media, digital editor for Pitt and Corey magazine, and I will be your event manager. Before we begin, I'm going to go over some ways that you can participate during today's presentation. Although you currently are in a listen-only mode, we encourage you to ask questions throughout the presentation. Just type in the text box at the bottom left, then click Submit to place your question in the line. You can also submit questions by Twitter by using the hashtag PQWebinar. Questions that were submitted during registration have already gone to our panelists and may be covered in this webinar. Some questions may also be answered in an upcoming issue of Pitt and Corey magazine or in one of our e-newsletters. We strive to answer as many of your questions as possible. If you experience any technical difficulties during today's event, use the same Q&A box at the bottom left to tell us about your issue and click Submit, and assistant producer Bethany Chambers or I will personally assist you. Finally, a recording of this webinar will be available tomorrow afternoon at pittandcorey.com/webinars. You can get to that page now and bookmark it by clicking on the header above your slides. A link to the on-demand recording will also be emailed to you when it is available. Now, I'd like to turn today's event over to our moderator, Pitt and Corey Senior Editor Kevin Yanik.
Thanks, Allison, and thanks again for those of you joining us today for this Pitt and Corey webinar. I'm Kevin Yanik, Senior Editor of Pitt and Corey, and with us today we have George Redden, a Managing Director with FMI Capital Advisors. George will offer a construction outlook for the coming months, and he'll discuss a number of the variables expected to impact demand for construction materials. George is always great about offering some historical context about the state of the industry, and we'll see today how the industry is positioned in a number of areas relative to recent times. George has been a great friend to the magazine over the years, specializing in mergers and acquisitions and financial advisory services. He's a regular speaker at our annual roundtable and conference, and you can find George's columns in the pages of Pitt and Corey 4 times a year. He's a great resource for aggregate producers and for those of you whose business is so closely tied to aggregate demand. Before I turn over the webinar to George, I'd again like to thank our 3 sponsors who came together and made this webinar possible. The 3 are FMI, Superior Industries, and Telsmith. We appreciate the support all 3 of you have shown in bringing this webinar to life. Now, the bulk of the speaking today will be handled by George. He'll deliver a presentation for a good portion of the hour. George will sift through a number of slides and cover different economic-related topics. As a reminder, we'll take your questions as they arise via Twitter and via the Q&A box on your console. Near the end of the webinar, we'll address as many of your questions with George as we can. So with that, I'm going to bring George in, pass the baton on, and George, the floor is yours. We'll have George in a second here. I think he's just having some audio difficulties.
Sorry, Kevin, I'm here. I apologize for that, and thank you very much for having me here. As Kevin mentioned, I work for FMI, and FMI is a management consulting firm and investment banking firm dedicated exclusively to the construction industry. And within that, I've been for 25 years focused on what we're calling construction material producers, which includes the aggregate producers, Pitt and Corey's audience. We were founded in 1953. We have national coverage here in North America. We also work with international producers, but primarily as it relates to their investment interests here in the United States. The construction materials sector, as you can see in the slide, the way we look at it, it's the raw materials down through the lay-down contractor, the vertically integrated market. So I think as we talk about aggregates and demand for aggregates, it's also, I think we need to understand how it impacts the downstream use. So we cover what the industry tends to refer to as the construction materials sector. The title of the presentation is the outlook or the overview for the construction materials sector. And what's interesting is we just went and looked at a few of the major producers and what their thoughts were. At LafargeHolcim, after their massive merger, their CEO, Eric Olson, is talking about great opportunities for price increases. As demand is going up, they're starting to see some price increases as well. Ward Nye over at Martin Marietta also referring to some of the recovery that's going on at the DOT, a continued improvement in residential, and also leading to some improved pricing dynamics. Tom Hill over at Vulcan Materials, recognizing the impact that we're going to see from the FAST Act that we got in the fourth quarter of 2015, although, as he says, it may take until the latter part of 2016 before we really see the benefits of that. And Bill Sandbrook over at U.S. Concrete, he's addressing that while we're going to have a nice recovery, we're going to have the challenge that many sectors are having, and that is how do we attract and keep good labor. But overall, the outlook from the major producer standpoint is as good as we've seen it in quite some time. So what drives some of the demand for the product here? We'll look at some economic metrics here that comes from what's referred to as the consensus forecast. That is a grouping of economists where you take the median opinions about what's going to happen on driving the economy and therefore driving construction and for the aggregate products. And we will go, I'm going to go through each one of these individually. We look at GDP over this 5-year period, and it is, relatively speaking, modest, but that doesn't tell the entire story. This is from Goldman Sachs, and it tries to present nations' GDPs by the width of the bar, and then the growth expected in their GDP by the height of the bar. And what we found after the collapse of the financial markets in 2008 was a lot of investment going from the U.S., where we had a steep collapse, as did many mature Western markets, to other developing markets and markets. The BRIC countries became very popular: Brazil, Russia, India, China. And as you notice, China is, along with the U.S., one of the very wide bars and a very tall bar, meaning high growth, but declining growth, and leaving many with concerns about what happens if there's a slowdown in China. And I think stock market here in the last weeks has been a function of what is going to happen in China. Is there going to be a slowdown? All the way to the right, you'll see Brazil and Russia. Their bars are in negative growth, but expected to return. And the U.S. is in a very stable position, which makes it actually quite attractive. In addition, then we'll look at inflation, and as you can see again over the years, inflation continues at very low levels. And this graph that we're showing here is reflecting inflation over a period of time back to 1988. And what's interesting, if you look at the peak, that would be in the May-September 2008 period. And since then, very low inflation, and that's helped stabilize the economy and give it a base from which to grow from. The next driver is unemployment rates, and as we can see in 10 coming out of the crash, unemployment met double-digit levels and has since come down. So from that standpoint, that's good news for the sector. This graph shows both employment in terms of the numbers of people employed, and then the line graph is the unemployment rate. If you took a line and sort of tried to estimate the curve from about the beginning, 1970, say, till about 2004 or so, you have a trajectory over that period of time that if you continued it out to 2015, you'd probably be in that 160 million range up top, and yet we're down only in the 140s there. So the challenge has been, and it's all in the political discussions, is jobs, jobs, jobs. How do we grow more jobs? And we see that the unemployment rate is going down, but the level of job creation itself is not very interesting. This graphic now coming from the government statistics at the Reserve Bank shows you two things. It shows you in the blue, it shows you the employment rate. You'll hear people refer to the employment participation rate. And then the red graph is the unemployment rate. Now, the good news, again, is that from the crash, after in 2009, when we crashed, the unemployment went way up and it has dropped precipitously down. Yet, unlike other periods of time, the participation rate has stayed relatively low. So many would argue that the real unemployment is much higher than the 4.9% or so that is being claimed today. Again, if we look at other periods, if unemployment went down, participation rate went up and vice versa. But in this most recent period, as the unemployment rate has come down, the participation rate is actually not recovering. People are not in the statistics because they have given up on looking for work. Interest rates, another driver. We've been the beneficiary, as you can see, of very low interest rates, and that has helped us with financing and operating businesses. And this next slide shows a little longer term perspective on the U.S. 10-year Treasury yields. And again, as you can see, for the last 15 years or so, we've operated on well below historic averages, and in recent times at true historic lows in terms of interest rates. And while the Fed did increase interest rates in December, I think with what's been going on the last month or two with the stock market, it's questionable whether that will continue, at least in the short term. And again, if you look at the average from the beginning of the graph through 15, the average was 5.8%, and now we're at about 1.7. So we've had the benefit of very low interest rates. Housing starts, which is key because one of the big drivers for the aggregate consumption is going to be, along with the roads, going to be housing. And on the single-family housing starts, you can see the good news is, over this period we're looking at, that there is an increasing level of activity. The next graph shows a more historic perspective. And the graph begins in 2004, and if we had this graph back a few more years, we would have seen a very strong market for residential construction driving the economy here in the early 2000s, peaking around the 2006-07 timeframe. And as we know what happened in the fall of 2008, beginning actually early '08 was the collapse of the financial sector, all the challenge with the mortgage bond obligations. And the residential housing market crashed precipitously, probably hit hardest of any parts of our economy, and bottoms out in the '09 timeframe, and stays still for some time and then starts recovering. And this recovery has been, from a percent increase year over year, has been one of the strongest sectors of the construction industry in recent years. And we expect that to continue, as do folks like PCA. The next driver for economies can be oil, and I think that has been much in the news in recent days and months. And today we find ourselves in an oil price that very few expected. There is a oil industry conference starting tomorrow, and last year the experts at that conference predicted ranges of 55 to 65. So a year later they're off by half, which makes it very challenging for people to gauge where oil is going and where it's going to remain. This graph shows us domestic crude oil production in the U.S. starting in 1990, and shows us an estimate for 15 and a projection out in 2020. Technically, in 15, we believe the U.S. is the largest producer of oil in the world. And this run-up from the 2008 timeframe is largely a function of the technological advancements of horizontal drilling and fracking. We now were able to go drill down, frack as we always had, but with the benefit of horizontal drilling, they were able to go out and create immense yields from the same drilling locations. It dramatically increased our ability to access oil and natural gas. At the same time, OPEC decided that they would maintain their production, which had the benefit of driving prices down as Economics 101 set in, where supply outstripped demand and prices dropped. Here's a graph that will show a historic perspective in the last 10 years of oil prices and the recent low that we're experiencing. Construction, all construction put in place as gathered by the government, historically has been somewhere in the neighborhood of 7 to 7.5% of our GDP. And the graph would show you from 94 up till the crash, that's about where it was, maybe a little stronger during that period. And then it dropped, and construction again, led by residential construction, took a big hit and is recovering and working its way back to more traditional levels as a percent of our GDP. This graph goes back to 1964, gives us a nice long-term perspective of construction put in place, and breaks it down to a few categories. We have residential in the red related bar. We have non-residential buildings, and then non-building structures, which is going to be more of the public construction. And as you might imagine, you'll see less volatility in that line. Again, the graph shows the historic rise in residential construction leading up to the crash in the 6-7 time frame. The crash really not felt until 8, but the sales reports in the residential side, especially for people in the cement business, for example, were starting to come in as early as 2006. But as you can see by the graph, in that 2001 to 2006-7 time frame, unprecedented growth in the residential side, and then the precipitous drop once the financial crisis hit. And a strong, steady recovery, but again, far from the peak, even where we have it forecast out into 2019, 2020. The next two slides are going to give you detail, and this slide deck is available to the participants. It's going to give you detail on the makeup of the various subcategories here in residential buildings, non-residential buildings, and non-building structures. And as you can see, in 2015, total residential at $396 million was nearly 40% of the total. And the other big driver in aggregates down below is highway and street, and that's another 8 to 9%. And so those are your two big drivers. If you look at 2019 for residential, it moves from the 396 in 15 to 531 forecast in 19, about a 33% increase. And highway and street going from 80, nearly 88, to just over 96, about a 10% increase. The next graph shows these same categories, but instead of the dollars, it's the year-over-year increases percentage-wise. And if you look at the total residential, and in particular the single family, which is the most intense user of construction aggregates, it's the number one growth category from 15 to 19 of any of these categories on this slide. And I think that's really good news for the sector. On the other hand, highway and street down below, the other big driver, is the lowest expected percentage increase of all the categories here. So a little mixture of good news and bad news. We'll talk more about the FAST Act and why maybe not so much from a funding level perspective, but the predictability of funding is still good news for the sector. A little further discussion on the residential side. Again, the graph is becoming a repeat with the run-up of the sector in single family on top in the early 2000s. Big drop and the slow but steady improvement, but still well below at the end of the forecasted period from the peak years. But the growth rate that we're seeing in 15 was about 13% for single family, and we're expecting another 11% here in 16. So steady, solid growth in residential construction will be, the aggregate sector will be a big beneficiary of. Multifamily, the same. It's a much smaller category, as you can see, based on the numbers on the left-hand side, but still very solid growth, 24% in 15, and expected another 11% in 16. As mentioned, the other big driver for the sector is highway, and it's a little different story. Didn't have the same run-up in the early 2000s, primarily public funding, and the FAST Act that came in, a real shot in the arm because the sector had not had a long-term highway bill since Safety Lou expired in the fall of 2009, and lived with over 40 continuing resolutions since 2000. This graphic summarizes the federal highway bills that we've had since they began in the early 90s with ICE-T. And ICE-T, prior to this, we were budgeting annually for roads. The sector was looking for long-term planning for roads. They could make long-term planning for their equipment, for their plants, for their staffs. And they got that with ICE-T in the early 90s, followed by T21. After T21, a slight stall in trying to get Safety Lou passed in 2004. Had to deal with some a year of continuing resolutions. Safety Lou then, as I said, expired in the fall of 09, and from 09 until here in December, we basically lived on continuing resolution. Even though we did have the MAP 21 program highlighted by the blue bars in 12, 13, into 14, it was really just a long-term continuing resolution at flat funding. And then in 16, from 16 to 20, we're representing the FAST Act program. Now there's a line graph also through there. And that line graph is taking inflation into account. And so in constant dollars, if you look at it, we've actually had flat to arguably lower spending in the sector. So I think, again, FAST Act was a great thing, shot in the arm, 5-year bill, gave people the opportunity to plan capital, plan plant expansions, staffing, but the funding was, relatively speaking, flat. There's a group called SC Marketing, and they did a study on what they felt the FAST Act would do in terms of incremental impact on aggregate tons. And the bar chart on the left gives you the incremental tons that they are factoring in. And the bar chart on the right, the red, top of each bar is the red piece, and that's the impact of the FAST Act on each year. And so as you can see, it's a relatively modest impact. But again, from planning points of view, and in talking with a lot of equipment and plant manufacturers, they're seeing great increases in demand for their products because now these producers have the visibility of funding for a 5-year period. So the overall result here, this graph shows you the volumes and some pricing on different areas of the construction materials sector. Construction aggregates on the top left, ready-mix concrete on the top right, cement and asphalt. And again, the graphs are similar to what we saw. They mimic the rise, the strong markets in the early 2000s, the collapse with the financial markets in 08, and the steady but relatively slow recovery that's forecasted out in the forecast period here for most people to about 2019. This graph is a chart of the performance of what we were referring to as the Construction Material Index. This is a grouping of publicly traded companies, and we track their stock performance against broader market indexes like the Dow Jones Industrial Average and the S&P 500. And as you can see, over this 10-year period, up top there in print, the percent change, this Construction Materials Index was only up 10.5%, while the broader indices were up about 50%. And again, part of it was we were the darling of Wall Street in the leading up to the crash, and we got hit harder than the other sectors. And it took a long time for people to determine when the residential market was coming out of its recession and into its recovery. And of course, we had the absence of any federal highway bill. So there was lots of uncertainty. Uncertainty is death for publicly traded securities. They also found themselves with tremendous amounts of leverage from aggressive acquiring prior to the crash. So the sector did not perform well during that period. This next graph now looks at it from a one-year period. And what we find in the last year is that the construction materials index actually far outperformed the broader indices. And so questions as to why. I think there were a number of events leading just prior to the start of this 12-month period. Martin Marietta had a successful acquisition of Texas Industries and was integrating that according to plan. Then the Lafarge-Holcim merger was completed according to plan. Then Summit Materials had the first IPO in the sector in over 15 years. And then we continued to see steady improvement in residential construction and the anticipation and final passage of the FAST Act at the end of the year. And I think this collection of events gave people confidence in the sector, and we started seeing an increase in investment activity. Next two pages are going to provide some statistical information on these CMI index public companies. In the shaded area off to the right are some market pricing ratios. EV stands for enterprise value. It's the market cap of the equity, adding back debt and subtracting cash. And we do that because what we see in merger and acquisition activity in the sector is that deals are quoted on enterprise value. When a major company acquires a private company, it's a cash-free and debt-free deal. So it's based on the enterprise value, and that's why the Street quotes market pricing ratios as enterprise value to these various metrics like EBITDA or EBIT. The next page shows some of the operating performance of the sector. And as you can see in the middle, the more aggregate intense one is, the higher your EBITDA margins are. The more vertically integrated one is into the contracting, the lower your EBITDA margins are. On the other hand, one can still generate the same attractive return on assets, but the metrics are different. So if we looked at a CRH or a Summit Materials or a Granite, in particular, Granite, say, and CRH, two of the bigger companies that have significant construction-related activities, they're going to have lower EBITDA margins, but similar return on assets employed measures. This chart shows the collection, the average of the EBITDA margins for these companies within the CMI index. And again, as you can see, the very attractive EBITDA margins leading up to the crash and the drop. As volumes dropped, demand dropped, so did pricing. Many of these companies are manufacturers. And as your manufacturing plant runs at inefficient capacity, your cost structure gets out of whack and it impacts your earnings. As the volumes are slowly returning and the market's improving, there's an opportunity for both throughput cost improvements at the manufacturing plant, but also some price improvements and therefore the margins. So we're seeing a trend back towards historic levels on the EBITDA margin. This graph then is representing what one might say is what multiple of EBITDA do these companies trade at. It's the ratio of enterprise value to EBITDA, again, collectively for the group. And we can see on the left side of the graph in 2008, where the pricing ratios dropped way down as the market found itself in crisis. And if we were to smooth that graph from left to right, we would see steady overall improvement in the pricing ratio, approaching historic norms. One of the big challenges for the sector was expanding into what ultimately became a declining market and carrying too much debt. We had companies like Cemex buying companies like Rinker. We had Vulcan Materials buying Florida Rock in December of 2007. And the market crashed, and they found themselves with these deals that they acquired being financed by debt, and found themselves, if not in, very near to being in default of their loan covenants. So the marketplace took the position of, if we have cash, we're going to keep that cash. If we don't have cash, we're going to raise it. And many of these companies entered divestiture programs. And you had companies like Lafarge going through major divestitures, Cemex going through divestitures, Oldcastle completing a divestiture program in 2015. And they spun it as shedding themselves of non-core assets. But it was really part of an overall strategy to get their balance sheets back in order. And they have, for the most part. As you can see, these are leverage ratios. The total debt as a multiple of EBITDA. So as EBITDA is improving and debt's reducing, the ratio is beginning to return, but is not yet at the historic levels. But they're improving, and what it's allowed these major companies to do is get back out in the market, in the acquisition market. What we had in the pre-crash was investment from across the globe coming into the U.S. And for investment bankers, we called it a frothy market. Businesses were auctioned. There were numerous bidders. The prices were outstanding. Lots of buyers. Capital being attracted from more mature markets like Europe, where maybe the top handful of producers controlled 90+% of the market. Looked at the United States. It was a fragmented, privately owned construction materials business, and there was a great amount of merger and acquisition activity. With the crash, other markets became more attractive globally. And so when you had true global producers, they were looking at competing investment alternatives from around the globe, and the U.S. was not looking good. And so the capital left and went elsewhere. And more recently, as we showed with early in the presentation with some of the BRIC countries and emerging markets, the growth opportunities aren't as attractive there as they once were. Things are improving here. We still have a very friendly currency, very friendly labor force here, and investment in the U.S. is much more in vogue now. This is a list of a group of what I'll call mega transactions. The market from 2008 through, say, 14, really dominated by small to medium-size strategic acquisitions. You might go to the website for a company like Oldcastle and see that they may have spent over $200+ million in the United States on deals, but they may have done as many as 20 or 22 or so deals. So they, on average, were doing a lot of small tuck-in strategic bolt-on acquisitions, where the synergies that they had made it presented an opportunity where they could provide pricing to the target company that got their attention. Last year, and really the tail end of 14, we saw the return of what I'll call the mega merger. And in fact, during that time period, we had more M&A activity on a dollar basis than ever in the history of the sector. the much written Lafarge-Holcim number 1 and 2 merger, Oldcastle then purchasing a significant amount of the assets that they had to divest because of the antitrust potential issues that the Departments of Justice and Federal Trade Commissions looked at. Heidelberg buying Italcementi, which in the United States is SROC. Martin Marietta, as we mentioned, with TXI. Summit Materials also bought some of the Lafarge-Holcim assets. That's $450 million, not billion. That's a typo on your right. Lane was bought by Italian company Cellini. And Martin Marietta then sold their California cement assets that they picked up in the TXI deal to CalPortland. And more recently, Summit buying American Materials in North Carolina and the Boxley companies in Virginia, and Martin Marietta buying some assets in Colorado. So more return to some large deals as opposed to just the continued steady diet of the strategic bolt-ons. As part of these large deals, what we found is that a lot of cement plants are changing hands. And we also find that companies like Oldcastle and Summit Materials have gotten into the cement business in a way that they had previously not been, which will be interesting to watch as now we have a vertically integrated construction material producer also in the cement space, which we did not have before this. And so in the eastern part of the United States in particular, there will be a lot of changes in the cement supply dynamic, which will have ramifications in particular for the ready-mix concrete producers and to a lesser degree the construction aggregate producers. Major companies in the construction material index have improved their balance sheets. We've seen they've returned to making large acquisitions. They've continued with a steady diet of bolt-on acquisitions. The other area of activity that we see improving and increasing will be the public-private partnership work. The FAST Act itself is modest funding, but we think, just like in other parts of the globe, especially in Europe, that we think there's a tremendous potential for private development and ownership of infrastructure, roads in particular, in this case, bridges and roads. This chart shows states that have some stress from a DOT budgeting standpoint, and yet are going to be friendly to P3 initiatives. And we've started to see companies like Cellini purchasing Lane, with one of the strategic reasons for doing that is to gain an access into the P3 market here in the States. We see other major construction material producers who historically have not participated in that also starting to look into the opportunities in the P3 sector. P3 has been around quite some time. The top bars are showing the dollars involved in P3 activity, and the bottom bars are showing the actual number of projects. As you can see, to date, it is just bumping along in terms of numbers of projects and dollars. But we believe if we follow some of the other more developed Western countries, we're going to see significantly more activity here. The developers and then the design-build contractors are listed here. And as you can see, on the investor side, it's going to be mostly those with experience, the European players. Very large companies with significant balance sheets using investment in P3 as part of a portfolio of investments that they make. And the design builders, those who would lead the construction of it, as you can see, are not a typical group of companies from the construction material sector. Granite and Lane certainly are in the construction materials market, but they're primarily heavy civil contractors. But if you don't have any of the top 10 producers of construction materials, be it aggregates, asphalt, or ready-mix, in this list right now. We think that could change. In conclusion, FMI is cautiously optimistic about the sector. We see things lining up right now better than we have since the crash in the fall of '08. So really, better than we have for 10 years. We think that because of that, and because of what we saw with the construction materials index outperforming the broader indices this past year, we see the market making more strategic acquisitions and also focusing not just on the bolt-ons, but more market growth acquisitions. We sometimes refer to them as platform deals. We think it's going to be a very active market here in 16 and 17 on the merger and acquisition front. The market will be consumed still in 16 on divesting the billions of dollars of mergers that have taken place, and we'll continue to see some divestitures. The FAST Act, as we said, along with the steady and improved residential markets, are a real shot in the arm for the sector and going to have a big positive impact on the activity. All that said, as optimistic as we are, there are clouds on the horizon, and exactly what happens there, we're not sure of. But what's going on with oil, what's going on with our elections here this year, going on in the Middle East, declining growth in China, all these things have not fully played out yet. And historically, we run in about a 6 to 8 year cycle on recessions, and we're about 6 years plus into this recovery. So while we're cautiously optimistic, there are reasons to keep an eye out on some of the clouds above. Thank you very much for your attention.
Thanks, George. There always seem to be some clouds on the horizon for the industry regardless. Hopefully they're not the darker storm clouds with thunder and lightning, but it is an exciting time for the industry. There's a lot of merger and acquisitions taking place, the mega ones you're talking about, and it's great to have the FAST Act in the bag. We're looking forward to seeing how things shake out this year and the next few years. At this point, we've got some time remaining. We're going to answer some of the questions with George that were shared by the audience. I'm going to bring in my colleague Darren Constantino, the editor-in-chief of Pit & Corey, to handle this portion of the webinar. Darren?
Thank you very much, Kevin, and thank you, George. George, we have some questions from our readers and from the Pit & Corey staff. And let's start off with question 1. Construction materials demand as it relates to oil and gas has tapered off. Is this the new normal for that segment?
Obviously, the tremendous rise, as we saw in the graph, oil production increased with the advent of horizontal drilling and expanded fracking. And a lot of infrastructure went in to developing the roads and the pads, and the demand for aggregates was enormous. Distribution networks are being built out now, and there'll be some. But I do think that the areas, the Marcellus Shale area, for example, the North Dakota markets, some of the Texas areas, can probably expect this to decline to be a new normal for some period of time.
Thank you. And another question. What are your impressions of the Summit Materials acquisition of Boxley Materials, which was announced last week? How does it reposition Summit Materials, and what are the implications of the acquisition on the market?
So as you know, Summit Materials has embraced a materials first acquisition strategy, but embraces a fully integrated model, which the Boxley companies represented. Whereas you have other buyers who are trying to stay as strict to aggregate production as they can. So it was an attractive opportunity for Summit. Summit, as you know, went public last spring and has a fairly aggressive growth initiative. As part of that announcement, it was also incorporating an acquisition in North Carolina, a sand company on the East Coast, American Materials. So it really gives them entree into two new markets, that announcement. And again, that's an example not of a strategic bolt-on deal, not of a mega merger, but of what I'll call a platform acquisition, which we saw a much greater diet of in the early 2000s. And that type of transaction, they were far and few between since the fall of '08. And so I think that's a really good sign for the market, that you can have companies who would not be deemed necessarily the strategic buyer in that case, coming in and competing to add new geographic markets for their growth strategy.
I see. Well, that's good news. Do you anticipate any additional major industry mergers or acquisitions to occur in 2016, or more of the bolt-on nature by the major producers?
I think there's going to be a focus on integration of the major deals. So I don't necessarily see 16 as being the year of the mega deal. We will always see the strategic bolt-on deals. Those are opportunities to bridge the gap between price differences of buyers and sellers, because the strategic benefits can be calculated into the valuation. What I do expect to see is more aggressive pursuit of the platform acquisition, or we can call that the larger but not mega transaction. They may be defined in the 50 to 250 million enterprise value range, whereas when we think of the strategic bolt-on deals, we're probably usually thinking under 50 million in enterprise value.
Thank you. You mentioned toward the end of your presentation a little bit about the presidential election and the uncertainty that brings. What impact would you anticipate the potential outcomes of the presidential election having on this industry?
Well, Darren, the politics, especially recent politics, I think have caught many people off guard. But what we found with really, the beginnings of for example, the Tea Party and Grover Norquist's success on his no tax pledge was certainly impacted what went on in Congress as it related to the new transportation bill, because it got included in new spending and new taxes discussion. And so the gridlock that we've seen has had a negative impact on our sector. We really went a long time without this federal bill. So does the election ease the situation in Congress? Does it make it worse? I'm not going to hold myself out as a political expert, but the Democrats are going to spend more, and in theory that's good for the businesses and road building and what have you. But exactly what happens, it certainly doesn't appear to me that we're heading towards less friction in Congress.
Right, I agree with you there. And the next question, should aggregate producers be optimistic about making capital expenditures in the current economic climate?
You know, aggregate producers did like many business. When they entered a period of uncertainty, they deferred some capital expenditures. They maybe even shed some what they might have deemed nice to have but not necessary to have assets, and maybe reemployed the capital in the business elsewhere. They maybe extended maintenance on some assets and truly deferred capital expenditures. I think the FAST Act, one of the big psychological benefits of the FAST Act is I think it's given producers a reason to tackle their capital expenditures now after having deferred it for quite some time. And again, as we mentioned, the dollars being spent aren't necessarily that impressive. But now having the runway for a 5-year period, I think we're going to see a lot of companies who put off their capital expenditures get back into the acquisition mode.
Thank you, George. Interest rates. You mentioned interest rates have hit record lows. Do you have a sense of how interest rates will trend in the coming years, considering we've bottomed out?
We know in the fall, fourth quarter, we had one of the first increases in interest rates in quite some time. And I guess it was good news, bad news. Nobody wants to see interest rates go up, but it was arguably because of the strength of the economy. And I think that in the period since then, we've come to question whether there's really that strength. And so many people think that instead of continued interest rate increases, that at least for the foreseeable future, we may actually see the Fed pause again before increasing again.
Oh, that's interesting. One last question. What impact has milder weather across much of the United States had on construction materials production this winter?
Well, if you're in a market where you can produce during this first quarter, it's obviously been a big benefit. And of course, every year we hear either of bad weather, deferred activity, or we were beneficiaries of it. If you were in cold weather markets, you maybe were in a position to operate a little longer into your season, but probably didn't have a big impact on you because you weren't geared up and the projects weren't there to work on. It really depends on what geography you're in. And it's really not new demand, it's just the timing of it, and we do measure things in 12-year periods, so sometimes it can have an impact. But I don't think the good weather necessarily changes the total demand, just changes the timing of when the demand takes place.
Okay, very good. George, those are all the questions. Thank you very much again, and I'm going to kick this back to Kevin Yanik. Kevin?
Thanks, Darren. Thanks, George. We're getting toward the finish line here, so I'm going to bring in our digital media content editor, Allison, one more time just to share a couple of final takeaways for our audience. Allison?
Thanks, Kevin. And thank you, everyone, for attending today's Construction Outlook webinar, sponsored by FMI, Telsmith, and Superior Industries. If you have any more questions, do not hesitate to contact our presenters at the emails on your screen now. Links to their email addresses are in the bios at the left. You can also download a PDF of the slides by clicking the Download the Slides box at the bottom left side of your console. An on-demand recording of today's webinar will be emailed to you tomorrow afternoon and will be available online for a full year at pittencory.com/webinars. If you'd like to share this webinar with your colleagues, you can do so via any of the links on the left-hand side of your screen. Thank you again for attending today's webinar. We look forward to seeing you at a future webinar.